Hello everyone, Elizabeth Rose here. I wanted to talk to you today about mortgage rates. Specifically, how are they determined? How is that magical interest rate come to be? And you know, it's interesting to me as I watch the media how often they get it wrong. In fact, almost all the time. You see, they're watching the wrong instrument. And it's important for you as a consumer to understand that there are different instruments out there, and you want to make sure that you're working with a professional who's watching the correct instrument. So the media is talking about the 10-year Treasury note. And while that is a bond and money does move in and out of that market, it is not what determines mortgage rates. You see, Treasuries are backed by the full faith and credit of the U.S. government. That is, in essence, it's collateral. On the other hand, mortgage bonds, which is where mortgage rates come from, are backed by, what do you know, mortgages. That's the collateral behind a mortgage bond. So how does it work? Well, you see, the bond market works very much like the stock market. Think about stocks for a moment, because we're also familiar with that. If you were looking at stocks and you were looking at Apple and Google and Microsoft and all the other players in that arena, you would notice that they're all different. They're all competing for the same investment dollar. They're all competing for that person, that investor that wants to invest in technologies. Well, bonds kind of work the same way. You see, money flows into the bond market and the investor has a choice. The investor can choose to invest in a 10-year Treasury or in a mortgage-backed security. So they're competing for the same dollar. They don't necessarily trade in the same direction in complete lockstep with one another. Now, while on most days they do travel in the same trend direction, they're not necessarily joined at the hip, if you know what I mean. So, as the money comes in and an investor chooses to invest in mortgage-backed securities or mortgage bonds, as they're commonly known, then as that money comes in, the market improves, the pricing improves, and mortgage rates improve. Now, when money exits the bond market, money flows out of bonds, the market worsens, prices worsen, and what that means to you, the consumer, is mortgage rates worsen. So why is it so important that your professional, your mortgage professional, know which instrument to be watching? Well, think about this. There's many times when the treasuries and mortgage-backed securities trade in the opposite direction. If that's the case, and it's while your loan's in process and you're watching the market, or your professional's watching the market with the finger on the lock trigger, and they're watching the wrong instrument, well, they can make a bad decision. If mortgage-backed securities are rallying, but yet the 10-year Treasury is not doing so great, they may be wanting to lock, and you miss out on that wonderful rally opportunity, which means you miss out on a possibly improved interest rate. So it's very important to ask your mortgage professional, what instrument are you watching? What are mortgage rates tied to? If they answer the 10-year Treasury, they're wrong, and you should look for someone new. Remember, mortgage rates are tied to mortgage-backed securities or mortgage bonds, which are collateralized by mortgages. So that's your tip for today, and I look forward to speaking to you again soon.